Okay, in this week, we will study stocks and their valuation. Uh, we will first try to understand what is stock, what is difference between uh, common stock and preferred stock. We will discuss um the primary, ba- some basic definitions of difference between primary and secondary market and initial public offering. Um, then we will discuss the different approaches to uh, find different approaches used to find the value of a stock. For example, dividend growth model. These are the models which are used to find the value of a common stock. We will discuss then the corporate value model, um, and then the third type of approaches which are being used are the using the multiples of comparable firms. For example, price to earning ratios. On the basis of price to earning ratios of if two firms uh, which are comparable, of course, we can find the value of a common stock of one firm based on the price to earning ratio of other firm. In dividend growth model, we have two further subcategories. Constant growth model, where we assume that dividends are expected to grow at a constant rate, and the second type is the supernormal growth model, where we assume that the dividends are going to grow at a faster rate at some initial periods, and after that the dividends are um, going to assume a constant growth rate. As we know that the value of an asset is basically the present value of all future cash flows that the asset generates. So common stock, since they are going to produce only dividends, so we can discount the dividends. In some cases, some firms they don't pay dividend, then we apply the corporate value model. We find the value of the entire firm, and then we can subtract the value of debt and value of preferred stock from the value of entire firm. That will give us the value of all the common stock, and then we divide the value of total common equity to the total number of common stock outstanding. That gives us the value of a single common stock. And then third type, as I explained, is the using the multiples of comparable firms. So again, we will discuss here the uh, dividend yield and capital gain yield. So if you buy a stock today and you are going to sell it after 1 year, of course prices are fluctuating. So you can sometimes price can appreciate or sometimes price can decline. If it is appreciate, if it appreciates, then you are supposed to capital gain, and if the prices are going down, you are supposed to face a capital loss. And you also get the dividend. So we calculate the total yield as a sum of uh, capital gain yield and uh, the dividend yield. So and and then we discuss here how we can calculate uh, the discount rate, for example, required rate of return by which we are going to discount the cash flows. And uh, we will also discuss here the market equilibrium, how the stock prices are determined in the market. Then we will discuss the factors that can affect the stock price in the stock market, and we will briefly discuss the efficient market hypothesis. We will discuss its three form: weak form of weak form of efficiency, semi-strong form, and strong form of efficiency. Um, and when then we will discuss the value of how to find the value of a preferred stock. So that will be the topics which we will discuss in this chapter.